So if you've ever heard anything about index funds or Vanguard, then I'm sure you've heard of the great John Bogle. He's the author of the little book of Common Sense Investing. Okay, so I'm going to share some of what I've learned from Mr. Bogle. All right, so here we go. I'm going to be sharing my screen with you. So the book that you need to read, if I just drag this over here, see if I can drag that over here quickly. Okay, and if I do that, so the little book of Common Sense Investing, accept. Right, so it's here, the little book of Common Sense Investing. Okay, so I'm sure you guys have heard about it. If you haven't, you've heard about it now from me. So this is a book that I would encourage you to buy on Amazon and yeah, read through so that you can get more knowledge if you're interested in investing. Okay. So I'm going to walk you through 20 tips that I learned from John Bogle, the father of index funds, that helped me to start investing properly. So I was investing before, but when I really started investing, I think during Corona, I think it was in 2020, investing properly was after I read this book, the little book of Common Sense Investing by John Bogle. And that's a book that I'm going to link it in the description below so that you can go on Amazon and purchase it. So if you've learned anything about index funds or ETFs, or Vanguard, then I'm sure you've heard about John Bogle. So I'm going to share with you what I have learned. If this is your first time on the channel, welcome and great to have you here. If you've always visited the channel, then that's awesome and great to have you again. Thank you for supporting the channel. If you haven't yet subscribed, what are you waiting for? All right, I'm going to wait for you. See, I'm going to wait for those who haven't subscribed. Yes, you're getting value and you haven't subscribed. Yes, I'm waiting for you. Show me some love so that I can send you a virtual hug in the comment section below. Yulin, I have subscribed to your channel. You forced my hands. Thank you guys. Thank you so much. So let me give you what you're here for. So as I've said before, 20 tips I learned from John Bogle, or 20 things I learned from John Bogle, the father of index funds, that helped me to start investing properly. The first one, index funds make up for the lack of their short-term excitement by their exciting long-term productivity. Today, if you wish, you can hold all your wealth in a diversified portfolio of low-cost traditional index funds, representing every asset class and every major market in the USA and around the world. Thanks to compounding, index funds are the only investment that essentially guarantee that you will capture your fair share of the returns that business earns. Traditional index funds is broadly a diversified holding of all $26 trillion of the US stock market, and it operates with minimal expenses, no advisory fees, and high tax efficiency. Number 5, the traditional index fund tracks the Standard & Poor's 500 index, which are the dominant firms in the USA, which I'm sure those of you who are investing will already know. Buying an interest in each stock in proportion to its market capitalization and holding it forever. So that's the key, buying it and holding it forever. Number 6, buy or choose your stocks, then stay out of the market forever. That's what Mr. John Bogle says. And I am following it, that I have been following his advice, should say, since 2020. Number 7, some of the things to evaluate in a company before you start investing or before you think of investing in them. You've got EPS. I'm sure you guys have heard of EPS, earnings per share. Dividend yield, earnings growth, market capitalization, return on investments, which I'm sure you've heard of the term ROI, price earning ratio, market return, price book value, and price sales ratio. I'll do in another video where I'll break down all of what these mean so you can get a more detailed information in terms of what each of these different things mean when you're looking to invest in a company. Number 8, it is economics that controls the long-term equity returns. Number 9, accurately forecasting short-term swings of investors' emotion is not possible. But forecasting the long-term economics of investing has carried remarkable high odds of success. So that is as per Mr. John Bogle. Stock prices only go up when the expectations of investors rise, not necessarily when sales, margin, or profit rise. Okay, so stock prices only go up when the expectation of investors rise. Investing consists of 2 different games: the real market, which is equal to investing, and expectation market, which is equal to speculations. Number 12, S&P 500, which stands for Standard & Poor, which most of you are already investing. Not most of you, all of you are already investing. We know what this means if you're familiar with index funds. This index tracks the 500 stocks in the US top companies in this portfolio, which equates to around 85% of the market capitalization. Number 13, the world's first index funds is called the Vanguard 500 Index Funds. And that's one of the things that grabbed me to Vanguard, because as you can see, they are the father of index funds. And so, or Mr. John Bogle, I should say, is the father of index funds, which is aligned to Vanguard because that was the first index funds that came about. And so that's one of the reasons why I trust, and I've proven now a lot of the things that he said since I've started investing properly in 2020. Number 14, of the 360 equity mutual funds that existed when the first index funds was formed in 1976, only 74 of them remain, and maybe less as of today's date. Over that 40, number 15, over that 40 plus year period, the S&P 500 index grew at an annual rate of 10.9%. However, with today's lower dividend yield, the prospect of lower earnings growth and aggressive market valuation, it would be foolish in the extreme to assume that such a return would recur over the next 40 years. Because as you guys know, those who are investing, on average, we're getting 7 to 8% at the moment. Number 16, instead of joining the crowd of investors who dabble in the complex algorithms or other machinations, am I saying that correctly? It sounds like I'm mashing up the word. Anyway, or other machinations to pick stocks, or who look to past performance to select mutual funds. Why not choose the simplest of all solutions and buy and hold a diversified, low-cost portfolio that tracks the stock market? So that's what Mr. Bogle is encouraging us to do. For individuals holding stocks directly, trading costs may average 1.5% or more per year. Okay, so when you're holding stocks directly, so it's good to buy a pot of funds rather than holding stocks directly. Managed equity funds management fees are operating expenses averages and operating, let's read that again. Number 18, managed equity funds manage fees and operating expenses averages 1.3% per year. That's a lot of money from your investment that you're paying out in management fees. With investment, time doesn't heal all wounds. Where returns are concerned, time is your friend, but where costs are concerned, time is your enemy. So always look to cut your cost or make your cost as low as possible. And the last one, cost is the difference between investment success and investment failure. So these are the things that I've learned from Mr. Bogle and from reading his book, and they've what helped to guide me in terms of my investment decision, and they've been great so far. I'll share more of my investment journey as I go along, because I've now changed the channel to crypto, passive income and investments, and just personal finance tips that I have learned over the years, and I'm going to be sharing it on the channel and sharing it with you guys. So as always, there's nothing that you're going through today that you and God can get through together. You were great, you're awesome, you're wonderful. You don't need me to tell you that. Thank you so much for your time, and until next time, I'll catch you in the next video. Take care. God bless you. Bye-bye.